Some days I swear the market is just totally random. I'm staring at my charts, all my indicators, and it honestly feels like I'm trying to predict a hurricane with, I don't know, a wet finger in the air. It just feels impossible.
Yeah, I get it. And that feeling? It's because most people are fighting a modern war with old-school weapons. But what if there was a whole new toolkit? A completely different way to look at the market? Straight from this game-changing book, Advances in Financial Machine Learning. Today, we're going to open that toolkit right up.
Okay, so here's our roadmap. We're literally going to rebuild your whole approach from the ground up. First up, we're going to prove that the clock on your wall is lying to you. Then we'll figure out how to create labels for your trades that actually make sense. After that, we get to the cool part, betting with a brain, using something called meta-labeling. Then we'll unlock the secret of the memory keeper. And finally, we'll tie it all together into a brand new trading blueprint. Seriously, get ready because we're about to shatter some old ideas. All right, so let's start at square one. Before we even think about strategies or fancy indicators, we gotta talk about the data itself, the raw material. Because think about it, everything you've ever learned about charts is based on time. And that, right there, that is the first huge domino that's about to fall. Whoa, hang on a second. Are you telling me my daily chart, my 5-minute chart, the things literally everyone uses, are fundamentally wrong? That's the bedrock of technical analysis. How can they be that bad? It all comes down to one simple, powerful truth. Information, the stuff that actually makes prices move, it doesn't show up on a nice, tidy schedule, right? Think about it. You get a surprise Fed announcement, or some crazy news breaks overnight. In a single 5-minute candle, you can get more action than you saw in the last 5 hours. So your time-based chart is either completely missing that explosion of information, or it's just sampling pure noise when nothing's happening at 3 in the morning. It's like looking at the market through a funhouse mirror. Okay, and this right here, this chart just makes it so obvious. Just look at the black and green lines. Those are your standard tick and volume bars. They're just all over the map, right? Super spiky and erratic when the market's busy, then totally flat when it's dead. You just can't build a reliable model on that kind of chaos. But then, look at that blue line. That's for dollar bars. See how smooth and steady that is? That's the real heartbeat of the market. We're tuning into its economic rhythm, not just the ticking of some random clock. Oh, okay, I get it now. So a dollar bar isn't about time at all. It's about, well, dollars. It's a unit of activity. So we only make a new bar once a certain amount of money, like say $1 million, has actually been traded.
Exactly. You nailed it. We are aligning our sampling with the actual flow of information. And that one little change, it gives our data such better statistical properties. It's the foundation for everything else we're about to build.
All right, so we've got clean data based on activity, not time. Huge step. But now what? Well, what are we even trying to predict? We need a way to label a trade as a win or a loss. And guess what? The old way of doing that is just as broken as time-based charts. Okay, well, usually I just do the simple thing, right? I buy here, my profit target is maybe 2% up, and my stop loss is 1% down. That's how I decide if I won or lost.
Yep, that's the classic way, but it's way too rigid. Think about it. A 2% move when the market's dead quiet is a huge deal. But when things are going crazy, 2% is just noise. It doesn't adapt. That's why we need something smarter, the triple barrier method. It's dynamic, it breathes with the market's volatility, and this is key, it actually cares about how the price moves.
So check this out. When you enter a trade, instead of fixed targets, you set up 3 barriers. You've got your upper barrier for taking profit and a lower one for your stop loss. But here's the trick. They're not fixed numbers. They're based on recent volatility. So on a slow day, your target might be just 1% away. On a wild day, it could be 5% away. It adapts. And that third barrier, that vertical one, that's basically a timeout. If the price just meanders and doesn't hit your profit or stop loss after a while, you just get out. It's exactly how real traders manage their risk. Okay, that's brilliant. So the label for the trade is just whichever barrier gets touched first. Hit the profit target, it's a 1. Get stopped out, it's a -1. And if it just fizzles out and hits the time barrier, it's a 0.
That's it. Simple, elegant, and it's actually realistic. This is the target our machine learning model is going to aim for.
Okay, now this is where things get really, really cool. Let's say you've got a strategy, right? It's okay. It gives you some buy and sell signals. But the million-dollar question is always, how much do you bet on any given signal? Or maybe should you even bet at all? Wait, hold on. Read that again. The goal is not to predict the market. Instead, the goal is to predict the success of the primary model. What? Wow, that completely breaks my brain.
Right. It's a complete paradigm shift. That's the whole idea behind meta labeling. You stop trying to build one single perfect model that knows everything. It's impossible. Instead, you build a pretty good model that finds potential trades, and then you build a second model whose only job is to figure out when your first model is about to be right.
So this is the problem every single quant faces. Your main strategy, your primary model, might be pretty good at spotting potential winners. That's all that green, true positive stuff. The problem is, it also spits out a ton of signals that end up being losers. Those are the false positives. And those are the trades that just absolutely wreck your account. Okay, so the meta-labeling model it's like a bouncer at a nightclub. My first model brings a big crowd to the door, but the meta-labeling model is the tough guy with the clipboard who only lets the real VIP trades inside. That is a perfect analogy, absolutely perfect. The first model makes the call, buy or sell. The second model looks at the whole situation and makes the real decision. Bet big or sit this one out. It's a layer of risk management powered by another machine learning model.
And this is the payoff. Look at this. The Sharpe ratio, which is just a fancy way of saying your risk-adjusted return, how much money you make for the risk you take. It just goes through the roof when we switch on the meta-labeling filter. We basically just tell the system, hey, only take the trades you're like 70% or more sure about. And boom, all those lousy 50-50 coin flip trades just get kicked to the curb.
2.65x? That's just insane. It really is. And listen to this. This is the craziest part. You don't get that jump by finding more winning trades. You get it by being ruthless about avoiding the losers. You're just filtering out the bad ideas your first model had. You're trading precision for recall. You might miss a few winners, sure, but you avoid so many losers that your overall performance just explodes. Okay, take a deep breath. This is the last major piece, but man, it's a big one. We have better data. We have a smarter way to bet. But now, how do we actually create the features for our model? How do we prepare the data so it can learn? What we're about to talk about solves a problem that has been a brick wall for quants for decades. Okay, I'm already a little lost. Why can't we just use the price? Isn't that the thing we're trying to predict in the first place?
That is the perfect question, and the reason is something called non-stationarity. It's a complicated word for a simple idea. The personality of a price series changes over time. You know, a stock could trade around $10 for 5 years, then suddenly invent something amazing and shoot up to 100. A machine learning model looks at that and just gets totally confused. So, what have we done for years? We use the changes in price, the returns. They're stable, what we call stationary. But the problem is, when you do that, you wipe out all the memory of the actual price level. You lose all the context.
Yeah, this visual just makes it so clear. That green line, that's the price. It has memory. You can see the trends, the history, the story. Now look at the blue line. That's the returns. It looks like TV static from an old motel. In our quest to make the data stationary and model-friendly, we've been throwing out the single most important part, the memory. It's the classic definition of throwing the baby out with the bathwater. But what if there was a magic bullet? This is it. It's called fractional differentiation. Okay, stick with me here. Think of it like this. Regular returns are like an on-off switch. You flip it and you get stationarity, but you lose all the memory. The lights are off. Fractional differentiation is a dimmer switch. We can turn it down just enough to make the data stationary. You see that blue line crossing the threshold? That's what we want. But look at the orange line. We get to keep almost all of the original memory. It is the absolute best of both worlds. The perfect trade-off. I genuinely think my brain just short-circuited. So you're telling me we don't have to make that choice anymore between memory and stationarity? We can actually have both? We can have both. And yeah, it is absolutely revolutionary. Okay, I know that was a lot. We went deep. But the most beautiful part is how all these pieces click together to form one logical, super powerful system. And this isn't some far-off theory for 2050. This is the actual blueprint you can use to build better strategies right now. Okay, let me try to recap this. Step 1, ditch the clock. Use dollar bars to follow the money.
Perfect.
Step 2?
No more fixed profit targets. Use the triple barrier method to be dynamic.
Yes. Step 3?
Bet with the brain. Use a meta-labeling model as a filter to only take the best trades.
You've got it. And the last one?
Keep the memory. Use fractional differentiation so our features are both stable and predictive.
That's it. That is the modern quant workflow right there. So after all of this, after seeing a new way to sample data, a new way to label outcomes, a new way to size your bets, and a new way to create features, there's really only one question left to ask yourself, and it's right there on the screen. The markets of the 21st century are a different beast. Are you still trying to tame them with tools from the 20th?
Wow, my head is just spinning. I feel like I have to go back and just rethink my entire approach to this stuff. That was incredible. Thank you.
Hey, my pleasure. And, we've only just scratched the surface here. If any of this blew your mind, you have to do yourself a favor and read the book. It's Advances in Financial Machine Learning by López de Prado. I promise it will completely change how you look at the markets. Thanks for diving in with us today.